I'm in Marin County.
Just north of San Francisco. Nice. And Ira, you're back from Japan and in Melville. Where are you? Where
I
are you
am
today?
at my home office in central New Jersey. Yes, there is a central New Jersey.
Any celebrity sightings recently there in New?
No, I'm about 20 minutes from a couple of famous people, but haven't seen anyone famous lately. I'll see
John
I'll see you I'll see you
Bon
next week, so
Jovi?
that'll be my famous sighting.
The conference should be well attended. Rob, are you?
I'm going. Looking forward to it.
Absolutely. All right. Well, while we wait for Adam from Poly to join us, welcome everybody tuning into the Capital Markets Wrap here, sponsored by Poly. Thank you to Poly for doing that. We've got Ira Selman and Rob Kessel and my son events and so forth. Bobby is going to reappear or not, but we also have a couple survey questions at some point, and Robbie assured me that he would out there, or Mr. Kessel, you would throw out the questions at some point. We've got a lot to talk about. The I heard the phrase recently, steady volatility. Steady volatility. Ira, you're sitting there, you're dealing with loan officers, you're dealing with pricing, you're dealing with what might happen overnight. You know, gift airplanes or tariffs or who knows what all. Have you found it more difficult to hedge a pipeline in the last the previous 4 or 5 years?
Yeah, definitely. Even if we just look at, the last few months, the volatility and, last week of March through the first 2 weeks of April has been, just a perfect demonstration of that. Just when we thought things were going to calm down a little bit, looked like the volatility had calmed down maybe second, third week of April, seems to have picked back up again now. And even something as simple as timing of your loan sale. You're putting loans out to bid at 11 a.m. or whatever time you're putting bids out, and by the time those bids come back, that market could have moved significantly based on um, you know something that came out in the news that wasn't even data related. So whether it be a tariff announcement or a tariff agreement. So whether you're putting your loans out to bid or you're taking new locks in, trying to add coverage. The volatility does nothing to help that equation from, your bid-ask spread when you're trying to add coverage, or even, you're trying to remove coverage. It sort of it causes a lot of havoc. And to try to explain that to loan officers at times is even tougher because they don't understand necessarily how much volatility affects things like, your base pricing, your spec pay ups, just your hedging activity, and on down the line.
Yeah. Well, that about wraps up our call for today. Adam, thanks for joining here in the last 90 seconds.
Sorry, guys. My Zoom, I was texting Sam like, you have a new version or I don't know what, and it kept spinning, and then I had to download it, and so sorry, guys.
Fortunately, Polly's technology is far and away above your Zoom
Better than
calls.
Zoom, that's for sure. That's for sure.
There you go. Do you want for the assembled viewers and watchers and listeners, can you want to introduce yourself for 30 seconds?
Sure, you bet. My name's Adam Carmel. I'm the founder and CEO of Poly.
So, all right, I've got 20 more seconds to play with here. The interesting thing, people ask me, because this show is all about me, Adam, in case you didn't know that. I'm kidding about that, but people ask why I started sending a commentary out many years ago. And what did I see out there that made me want to do that? And I have my reasons, which I could go into at some point. But what about the industry that you saw what made you want to start Poly?
Yeah, I had started this mortgage company back in 2013, and um, eh, there was a few dimensions. First, uh, I was using when we were a rapidly growing mortgage business, and we were using really the legacy pricing engine back then. And my team and I had a myriad of pain points from the rigidity and inflexibility related to configuring margins, optimizing the revenue per loan, increasing costs and lack of automation in the workflows, um, not having real-time analytics and so forth. And so we ended up deciding to build our own proprietary pricing engine in 2015. And over that 3 or 4 year period, after that, we saw just massive ROI. And I ended up then going around to folks I knew in the industry and saying, hey, you know, what's your view on the capital markets stack? And they were actually quite positive on everything Rob had built and so forth. But the 800-pound gorilla, they weren't so positive on. And so I went to our board and I said, hey, I'd like to go start a vertically integrated capital market solution, a platform, if you will, and we're going to focus in on the pricing engine to start, and build something that has never been built before in the industry. And in doing so, our mission here has always been to how do we drive maximum ROI, maximum profitability, drive costs down, and deliver the most innovative and cutting edge experience also for loan officers. And so we've been doing that for 6 years almost or so, a little over 6 years. And so that's really why I started Poly. That was the why. And here we are, and it's kind of like one of these pinch me type things in terms of where we are and then where we're trying to go.
Yeah, success speaks for itself, and I had thanked Polly earlier in the show before you joined for sponsoring this monthly show. I wanted to ask Ira and Rob. I'll get to you in a second. Uh, Before I do, though, I wanted to ask Ira, what do you think, from a capital markets perspective, what kind of software sets itself apart from other software, just kind of generic software that's out there? What do you look for if somebody comes to you, third-party provider slash vendor, with something new or so forth? What do you look for? What sets them apart, if at all?
Yeah, I think the flexibility, number one, on being able to, you know, do something as simple as adding a field to the pricing engine that might not be set up by default. That I could program myself. I don't have to, jump through hoops to get something added to build it out. That I could just build everything myself if I need to. So that I think is number one, just the flexibility of the system. Some of the legacy systems don't allow for that flexibility, and being able to manage every little aspect if I need to, whether it be margin management, as was mentioned, where I might want to have a different margin for one specific field in our system. I want to be able to have the ability to build that out myself. And then number two is past customer or current customer experiences. So I want to know that you know that a company, no matter what the third party is going to deliver what they promise. And it's not, oh, you don't always want to be the first in on third party products, because you do want to make sure they've been truly tested, and people have had positive experiences with those systems.
There you go, Adam. Hopefully, you were taking notes there. Actually, you could argue that you probably took notes 6 years ago. Probably that's why Poly is what it is today.
I've been taking notes for since 2007.
There you go. Well, speaking of lengthy times and duration, I was going to ask Mr. Kessel here, Rob, how long have you been in residential lending slash capital markets? How many years?
Are you really going to do that to me?
Yeah, yeah.
1985, so 40 years.
Okay. So you and I started about the same time. So 40 years, and I don't even know if this is correct. I'm just talking off the cuff here a little bit, but 40 years, and let's say the Federal Open Market Committee meets 10 times a year, just because I can't multiply 40 times 12. We'll say 40 times 10. That's 400 Fed meetings that you have arguably been, you know, seen in your, and I don't know if the FOMC was meeting, 40 years ago, 10 times a year. I don't know. I didn't do any homework on this, but obviously last week we just had a Fed meeting and the Fed did nothing as expected. Uh, but how do if you were a capital markets person on this call, how do you explain the importance of the Fed doing nothing, and what, if any, influence that might have on mortgage rate and interest rate trends?
Um, there's these varying times when there's more going on than other times, and sometimes the market gets into a rhythm where it's just looking at uh, economic releases that are coming out monthly. Non-farm payrolls is an example, and you're on a trajectory, and the meetings are pretty low impact type meetings. And in that case, the whole landscape of expected inflation, which is, we know, really drives where mortgage rates are, where treasury rates are, isn't maybe as impacted. But in the recent times, as Ira kind of pointed out earlier, there's so much uncertainty. What's going to happen with tariffs? Are we on the precipice of a recession? So I think these times, more of the investment community is more impacted by what the Fed's doing, what specific things they're how they're approaching it from a policy point of view, whether it's current rate or what they're doing with their holdings of treasuries and MBS. Um, so I mean, and I've definitely over the years have taken more of a hands-off kind of perspective. I mean, I think that you just have to wait, let things develop. And when there are more volatile markets, like Ira said earlier, there's just different things you have to do. You have to pay more close to attention to intraday loan sales. You have to adjust pricing more often. You can't pass through full spec payups. There's just things you have to do with more volatility as a sensible capital markets person, just so you don't get caught exposed with faster moving markets. But maybe cover a little bit more than you asked, but that's kind of the how I feel about the perspective of over time and the kind of unique nature of the market we're in right now.
Yeah, that makes a lot of sense. It's we mentioned the term earlier in the call, steady volatility. Um, so Ira, going back to what you tend to look for, help you do your job, right? I remember, in the old days, or if you were a small mortgage bank, if you take in 5 locks, maybe you sell a security of, 80% of your locks. You just do that day in and day out, and that's that. Obviously, technology has changed, and your demand for technology has increased. Uh, the How does technology make your job easier, which in turn helps loan officers originate loans and helps you price more aggressively?
Yeah, well, I just wanted to mention one more thing in regards to the Fed. We think back maybe even 10 years ago, where, right now we have Fed speeches, we have Fed futures. We know what the Fed's going to do almost every time during these meetings. And even as little as 10 years ago, where you sort of had to guess what the Fed was going to do or interpret what the Fed said. It was a lot tougher back then. So the transparency now has definitely helped. So that's, I just wanted to mention that in regards to the Fed. As for the technology, for example, on the hedging piece. So as you mentioned, you're going to grab, 5 locks, you're going to hedge them at 80%. But you know, with all our branches or our loan officers, not everyone has the same pull through, right? So while those 5 locks may come in, one branch may pull through 4 of those locks, another branch may pull through one of those locks. So if I'm able to use technology to help identify those branches and hedge appropriately at those exact levels on what their predicted pull through can be, overall, that helps us with our costs and in turn would help us lower our margins to offer more competitive pricing. So for the branch that's pulling through at a high level, obviously I'm going to want to have higher coverage based on their pull through, assuming their pull through stays steady. Obviously, that's an X factor. Where if you have maybe you have a consumer direct, branch where they are just pounding the phones all day and inherently are going to have lower pull through, you're not going to want to cover those loans at such a high amount to someone that may be on a referral base. So being able to hone in on that coverage and specifically add coverage appropriately, whether it be milestones, branch, LO, purpose, term, product, and all those different levels generally lowers the costs for us as a company to hedge and inherently would be able to provide more aggressive pricing to our loan officers and borrowers.
Yeah, I would say, Adam, that Poly generally is known for its transparency and its ability to increase efficiency for a lot of lenders out there. And so you tend to view the world perhaps, and I don't know how you tend to view the world, but I'm guessing you're looking at prize solutions for lenders out there. Like your might be spent, how can this lender do their job better rather than just looking at some little slice of what they do. Um, so you have your finger on, a wide variety of lenders from a volatility perspective. And oh my gosh, this is, we've never dealt with this kind of administration before. We've never dealt with this volatility and so on. How does Poly react to all environments fully, or do some clients, do you think, tend to use different parts of Poly differently based on their expectations of the market?
Yeah, that's a great question. We start with more looking at things kind of at a first principles basis of, okay, where is the industry today and where do we think and what's the vision over the next 5 or 10 years? I was a mortgage banker for many, many years before this, and I learned that in that business, you're constantly having to react to the market and all of the volatility, constantly. When you're building this type of system, you really want to look out 5, 10 years and say, okay, for example, the cost to originate over the last 20 years has gone from, or 25 years, has gone from 2,500 a loan to 12,500 a loan. What can Poly do to help drive that 12,500 back down, right? There's been the same solutions over the last couple decades, and software's job is to drive costs down, not up. And so, if we were to be adapting and changing our vision and our strategy and our product roadmap, every, I don't know, quarter or two or whatever, based on what the Fed's doing or not doing, I think that we would be kind of like a sailboat without a rudder a little bit. We would just kind of be drifting into the sea and reacting to everything around us rather than saying, okay, this is what we want to execute on. This is where we think the value is. And, we got to make sure we're right. Of course, we would like it to be right, but if we're not right, we want to be able to kill that project quickly. We have that kind of approach on things. Now, simultaneously, we have our kind of call it R&D or technology group is enormous. It's just enormous. And we continue to invest in it. In a major way, we continue to invest in it. We always allocate, a very large percentage of that budget towards taking inbound requests from all of our customer partners on all of the enhancements and features they need and want. And very often times that is a reflection of what is going on in the market or where they anticipate the market going, because that's what's most important to them. We always say to our partners, our customer partners, your strategy is our strategy, and we want to be able to listen and learn, and what can we build for you as quickly as we possibly can. And so we definitely have our kind of like our compass, and it's pointing towards a certain direction in terms of our roadmap and vision and the new products we want to put to market and the features within each of those products. But then we also have, like I was saying, a huge budget allocated towards being very responsive in innovating on all of the requests we get from all of our partners, which of course is a reflection of the market too.
Yeah, a lot going on. You're going to have a busy secondary conference next week in Manhattan, I imagine.
Very busy. Yeah, very busy.
And Rob Kessel. So speaking of innovation, you basically innovated the academy about a year ago. You were getting ready to, you were planning rolling out your first semester, and are we in the second semester now?
We are done as of last week. Second graduated class.
And how was that? Did the second semester vary from the first semester at all?
We smoothed out some rough edges. I think we learned a lot from the first cohort to how to make the material a little bit more approachable. And we were a little bit too rough, I think, on students in the first semester with some of the assignments. So I think we kind of found a happy spot for that. But in general, very happy with it. And, it's exciting to get back into, engage with what the current issues of the day are. And so it's always fun to try and solve problems.
There's always a fine line between pushing the students to learn something and then pushing them so far that they burst into tears when they see your name on their phone calling. Hopefully there wasn't any of that going on.
There's a lot of love-hate with some of the tougher assignments, because I think ultimately people appreciate when they have to work hard at something and put the time in, that they learn it at a much deeper level, but they kind of hate the curve getting up to that point. But I think we're striking the right balance.
When does the next semester start?
In the fall. So
Okay,
summer
so you're
off.
gonna take the summer off. Very good. So I heard something interesting today. Given your 4 days of experience, you weigh in on, and that is we are seeing another Wall Street invasion. At least this is somebody saying this out loud. And I immediately flash back to 2003, 2007, when we had Salomon Brothers and Smith Barney and Morgan Stanley and you name it, buying product, dealing directly with lenders, saying, "Hey, we want this product. Can you originate it?" Or conversely, lenders saying, "Hey, we have a demand on the street by borrowers and loan officers or AEs for this kind of product. If we originate it, Salomon Brothers, will you buy it?" And more often than not, Salomon Brothers was willing to do that. Are you seeing out there among the lenders that you deal with and the Wall Street firms and so forth another kind of invasion where the B of A Merrill Lynch's of the world or whoever are dealing directly with lenders again and hungry for product? Or is it is all of this just hoopla that is I just happened to hear mistakenly and it's not happening?
Well, I'm probably not as close to talking to lenders as you are, so I mean, I certainly haven't heard of that happening. We hear, I think what I've heard more of lately are there's some non-QM possible bulk, possible hedged, interest out there, which is the first I've heard of that in a while. So we've had some conversations about mandatory non-QM, but I don't know if that investor was street based or not. And I don't know if Ira, if you've had similar inquiries or if you got a perspective on the street side.
Yeah, I mean, I haven't seen, the so-called invasion, as you would say, Rob. Um, but, we have a couple of outlets that, are selling to the JP Morgans and some of the bigger names, that are hungry for that non-QM product. So we're definitely seeing, bigger interest, from investors, for that non-QM product. So it could be an output of that. I haven't seen the, as you put it, the invasion of Wall Street yet.
We'll stay tuned.
Yes.
We'll see what happens, right? I've talked to people who have attended security conferences, and I forget the abbreviation for them. I think there was one in Las Vegas a month or two or three ago, where there were literally thousands of people who are buying this stuff. And Adam, I wanted to ask you, going off script here somewhat. You're Poly has made a name for itself for being focused on what originators need, want, require. Do you ever receive feedback from investors that are out there, whether they're Wall Street firms or the Penny Macs, Fannie Mae's, Freddie Macs of the world, in terms of what they would like to see your product do in the business?
Yeah, absolutely. We do. Um, it's definitely picked up here in the last, as we've really scaled out. We've seen those types of, we've had a lot more of those discussions in the last, say, 6 months, 12 months. And so we've now committed a pretty good amount of our R&D budget to executing on a number of really kind of cool things that have been requested of us. And all with the eye of driving down costs ultimately for the lender or the bank who are, selling into the secondary market. Creating far more price transparency and discovery, and things like that. And so, it's kind of early days, I would say, in that capacity. And I think what's been really cool for us to be a part of is that, we get these calls, we get these inbounds from, I mean, it's like dozens and dozens of buyers, honestly, including, by the way, some non-QM ones and some street firms asking, saying, hey, we'd like to do XYZ. We hear ABC about you at Poly. Can you work with us in building this out? And we'd love to be a participant in that, and help be a part of that solution. And so that's been really, really cool. It's been really, really exciting. And, we don't have anything to announce yet on this, but certainly we will eventually.
Like in 5 years. All right. I won't. Yeah, that's the thing. The people get geared up for these conferences. It's almost like they have a product that might be ready, 2 weeks or a month earlier. No. We need to announce it during the national secondary, so we can't roll this quite out yet.
The irony is,
Mr. Kessel, you had.
Oh, go ahead. Sorry.
Oh, go ahead. No, go ahead.
I was just going to say the irony is that in the last year or so, I've been seeing people announce products that aren't even a year away. It's been funny to watch, actually.
Yeah. Well, speaking of asking, Mr. Kessel, you have a couple survey questions that you wanted to kind of and see what people are thinking out there, and then I'd like to follow that up with talking about the results. But I also wanted to ask Ira what he's seeing in the market. Now, oh my God, untitled hole number two. You got to think of a more creative. So, Mr. Kessel, what are we looking at here?
It's good for the theme of the call today about what are the kind of things in secondary departments we have to think about in more volatile markets. And so this is just a general sense for the listeners when they're coming into the the office or opening up the position. How are they thinking about putting on their morning coverage? And after, kind of flattening out the position, are they trying to sell for, up through the morning, up through the day? Are they trying to lock in a rate sheet given the volatility? Are they just responding as the market moves and volume comes into the course of the day? That's the general impetus behind the question, and we're curious to see what the results are going to be.
All right. So, Ira, you can't answer this because host and panelists can't vote. And Rob, you'll have to work on your titling skills at some point. So, how will you know when the results? How will you know when you want to give it another minute or two?
Yeah, I'm hoping Robbie's gonna surface with the results when they come in.
I can do that.
All right. While Robbie's uh, tabulating and running the results by Waterhouse for verification, Ira, uh, your your finger, as always, is on the pulse with LOs that are out there. Is there enough business for them to be concerned about volatility, or are they just happy to have loans coming in more at this point?
I think in some way the volatility may be even more important because they're fighting for every deal. And when you have an LO that's maybe quoting a borrower in the morning and you know 3 hours later that market could swing based on you know something that's tweeted or something that's proposed, and that borrower is not locked, or if they have a borrower that's locked and suddenly there's some announcement that comes out, and now the borrower is coming to you with a competitive offer. I think even more so the volatility comes into play because we are in a generally lower volume environment. So the LO really has to be on top of things. On the secondary side, we have to be a little more open-minded when it comes to things like competitive offers, renegotiations, and things of that nature. Because listen, LO's volumes are down, and we can't have them losing deals. So in general, I think it's even more so important now than ever.
All right, poll. Wait a minute. Oh, there we go. There we go. All right, for those lenders, planning pledge positions, expected days, expected remaining lock volume. Nothing. Just wait to respond as locks come in. Is the appears to be the winner. Interesting. I've told this story before, and Rob, you'll remember looking at these results. We had a Tuttle company, our coverage at EF Hutton, really dating myself here, is a woman named Mia Paggi. And Mia lived in San Francisco where their office was. Drive in to the office and park on the street at 5 a.m. knowing that she wouldn't get a citation. And she'd run upstairs and she'd be at her desk by like 12 because she knew at 5:15 and sell what they expected to take in locks that day. Action, she hoped to get her piece of that pie. And then she would go back down and park her car in the garage and go back upstairs to her job. Um, People, I think the majority to that point, just see how lock volume is going. Um, and then Rob, did you question that you wanted to ask? Or was that the question?
No, I mean, we had in a previous call, we talked about what is the threshold of market movement before you change pricing, and the just some of the disruption that might happen if you have to change pricing too often. And so is that, it's just more just getting a sense for how people are approaching this kind of volatile market. So, if you can sell enough to kind of lock in at least several hours of the day, that's maybe less disruptive for production. But as technology improves and as integration to LOS data improves and more of that data becomes more available on a real-time basis, then there's certainly lenders have options to use the technology and sell as the data actually changes. And so I guess that's kind of what the results reflected, that half of the respondents are basically following the data and the market as it moves.
There we go. Ira, easy question. What are tariffs doing to interest rates?
That's the easy question. Yeah, I mean that's sort of the common question, right? Obviously, when we left off on Friday, there were questions in regards to any tariff deals. Over the weekend, we had that 90-day pause on the tariff with China, and then when we came in on Monday morning, obviously we saw a deterioration in the MBS market. It's sort of, on one hand, we have the tariff impact on inflation, and on the other hand, we have the tariff impact on income coming in. So we're sort of stuck in this weird position where it sort of remains to be seen how these tariff talks actually play out. And I sound like Fed Chair Powell, except I don't have the purple tie. But until we see actual impacts of these tariffs, we do not know, right? We're sort of trying to figure out what's going on and how the tariffs are going to impact. But until we see actual results, it's all talk.
Yeah, it's not an easy question. There's sometimes when economic news comes out, and even if you knew about that economic news in advance, you would you would guess wrong about the market's direction after that news came out. So it's as I tell people think capital markets is glamorous and we're wheeling and dealing and trying to figure out where the market's going to go. And the real answer is we just do it day by day by day, lock by lock by lock. And that disciplined approach really pays off over the years. And it's not trying to speculate on where interest rates are going to go or kind of, how the tariffs are going to impact the market. But it is good to know, because I would think that a lot of brokers are asking, what does this all mean? And it's been really there's been a lot on the last 4 months. So we'll continue to see that. Marcus Lamb chiming in saying it has the most Bloomberg terminals per capita of any country. There you go, Marcus. Thank you for that. Deb wrote that JP for MSRs. Rob or Ira, have you seen anything like that happening?
No, I mean, and
No?
I'm
All right.
again, I haven't been in the bidding cycle, but I haven't.
All right. There we go. Rob, you're more of a you've taken the scholarly route here. I'm gonna go around here to some extent. The national secondary. When are you getting into town, and what do you achieve during the 2 or 3 days of the actual conference?
Yeah, I get in on Saturday in time for dinner and be there through Wednesday. And I just listening, learning, meeting with all of our customer partners, what else we can do for them, what's their strategy, and where can we, what can we do for them in terms of their next kind of 6, 12 months, and also share with them our roadmap and how that aligns with what they're thinking, and and how we should kind of incorporate everything that they're looking for as well into that. So that's number one. And then number two, obviously, there's a bunch of industry peers and friends and so forth that we'll, want to meet with and kind of understand what's going on. And I loved these things that these conferences getting together, and I think it's an amazing opportunity to listen. I just like to listen and learn. So that's what I like to do.
How many people from Poly are going, roughly?
Um, Over, I think something like 20 to 25 at this point.
Wow. That's a lot of customer service.
Well, we have we've, of course, our sales team's going as well, but, so we've got a large team going, and we're really excited also to be together.
Good. And Ira, when do you get into town, and how long are you staying for, and what do you hope to accomplish?
Yeah, so I'll drive in on Sunday afternoon. I did see a comment in the chat regarding, Newark being rerouted. That there were some flight issues coming into Newark so just give anyone that's flying into Newark, you might want to give some extra time, but I'll be driving up. I'm only an hour and a half away on Sunday, and sort of, echoing what Adam said, the conversations with people and just, you know, hanging out it used to be the lobby, but now it's sort of the elevator bank, right before you hit the L or the K or the M elevator at the Marriott. And it's just the conversations, you're having with people. I'm personally having a lot of investor meetings that, I don't get the chance to see and have conversations face to face with a lot of these investors over the last few years, especially post COVID. So it's a good time to meet with everyone and, you know, uh, have conversations in regards to what they're seeing on their end, what we're seeing on our end, any pain points, any discussions, things of that nature. And of course I get to see Rob Chrisman. That's my highlight. So
Robbie Chrisman. Mr. Kessel, when do you get into town, and how long are you staying for, and what are you trying to do?
Well, yeah, I'm hoping that Newark thing doesn't kill me, but Friday night and seeing
Uh-huh.
a play. So very excited about that. A daughter's new apartment, and then I'm catching up with people that I haven't seen in 4 or 5 years that haven't had a chance to share a drink with or say hello to. So that's most of that is just catching up with some people.
So you're going to see your daughter's new apartment. That's not the name of the play you're seeing. You're actually seeing your daughter's new
Two separate
apartment,
things.
right?
Glenn Gary, Glenn Ross,
Yes.
that's what I'm saying. So very excited.
I saw it and it was excellent. You will enjoy it.
Thank
Uh,
you. Excellent.
Supposed to be good. The 45 minutes has flown by here. Adam, any parting words that folks should know about Poly?
No, yeah, we're just hard at work. Really appreciate everyone's time, and of course, Rob, these great conversations, and look forward to continued great conversations. Really appreciate it.
Yeah, well, and thank you for sponsoring this show. Ira, as usual, Rob, as usual, thank you very much for chiming in. And we'll see you guys in 4 or 5, well, let's see, Tuesday, Friday, yeah, 5 days or so. And nothing good happens after 10 o'clock at a conference. So get a good amount of sleep. Thanks, guys.
Thank you.
Thanks very much.